Welcome back to Control Your Money, the channel where we empower you to take charge of your personal finances. Today we have a topic that's on everyone's mind: how much home you can actually afford based on salary. We all dream of owning our dream home, but it's crucial to ensure we make wise financial decisions when it comes to such a significant investment. In this video, we'll dive deep into the factors that determine how much home you can afford based on your salary. So, let's get started. Before we jump into the details, let's establish a fundamental principle. It's important to find a balance between homeownership dreams and financial reality. Just because you can get approved for a certain mortgage amount doesn't mean it's the best decision for your financial well-being. So, the first step is to assess your current financial situation. Begin by analyzing your monthly income and expenses. Take into account your salary, any additional income sources, and deduct your fixed expenses like utilities, insurance, and debt payments. Once you've determined your discretionary income, evaluate how much you're comfortable allocating towards housing expenses. Experts recommend that your total housing costs, including mortgage, taxes, and insurance, should ideally be no more than 28% of your gross monthly income. However, it's important to consider the bigger picture. Let's say you're a high-income earner. While you might be tempted to spend more on a home, remember that you should also prioritize other financial goals, such as saving for retirement, emergencies, and other investments. Striking the right balance is key to long-term financial success. Once you've determined your budget, it's time to consider the upfront costs of homeownership. Beyond the down payment, you'll need to account for closing costs, home inspection fees, and potential repairs or renovations. Setting aside some savings to cover these expenses is essential to avoid unnecessary financial strain. Now that we have a solid foundation, let's delve into the details of calculating how much home you can afford based on your salary. The key metric lenders use to determine mortgage affordability is the debt-to-income ratio (DTI). This ratio compares your total monthly debt payments to your gross monthly income. Lenders typically adhere to two main DTI benchmarks. The first is the front-end ratio, which measures the percentage of your income that goes toward housing expenses. The second is the back-end ratio, which includes all debt obligations, e.g., student loans, car loans, credit card debt, in addition to housing expenses. As a rule of thumb, lenders prefer a front-end ratio below 28% and a back-end ratio below 36%. However, keep in mind that these benchmarks can vary depending on the lender and other factors. It's always wise to consult with a mortgage professional to understand their specific requirements. To illustrate this further, let's consider an example. Say you have a gross monthly income of $5,000. Using the 28% rule, your total housing expenses should ideally be no more than $1,400 per month. Now, let's calculate your back-end ratio. Suppose you have a car loan with a monthly payment of $300 and credit card debt with a minimum payment of $200. When we add these debt payments to your housing expenses, your total monthly debt payments amount to $1,900. To calculate the back-end ratio, divide your total monthly debt payments by your gross monthly income. $1,900 divided by $5,000 equals 0.38, or 38%. Based on this example, your back-end ratio is higher than the recommended 36%. This might signal to lenders that you're carrying a heavy debt load, which could affect your mortgage approval chances. While these ratios provide a good starting point, it's essential to remember that everyone's financial situation is unique. Some people may have higher or lower debt tolerance, depending on various factors like job stability, future income prospects, and lifestyle choices. Now that we have a solid understanding of the numbers, let's discuss a few practical tips to ensure you make a wise home purchase. First, always aim for a comfortable margin when it comes to your affordability calculations. Life is unpredictable, and unexpected expenses can arise. Having some breathing room in your budget can help you navigate these challenges without falling behind on your mortgage payments. Second, consider the long-term financial implications of your mortgage choice. While a longer-term mortgage may result in lower monthly payments, it can significantly increase the total interest paid over the life of the loan. Weigh the pros and cons before making a decision and choose a term that aligns with your financial goals. Finally, don't forget about additional homeownership costs beyond the mortgage. Property taxes, insurance, maintenance, and HO fees can add up quickly. It's crucial to factor in these expenses to ensure they fit comfortably within your overall budget. So, to wrap things up, determining how much home you can afford based on your salary requires a thorough evaluation of your financial situation, considering factors like your debt-to-income ratio and long-term goals. Remember, it's vital to strike a balance between homeownership dreams and financial reality. Thanks for joining me today on Control Your Money. If you found this video helpful, be sure to give it a thumbs up and subscribe to our channel for more tips on personal finance. And as always, stay in control of your money. See you in the next video.